A bank will hand a resident making a fraction of an attending's salary a mortgage with little or nothing down, no mortgage insurance, and a loan amount sized around the income they're going to have, not the income they have right now. That sounds like a gift. Sometimes it is. It's also exactly how a lot of physicians end up house poor by their second year as an attending, buried under a mortgage payment, sized for a life they hadn't actually started living yet. Today, I want to walk through the physician mortgage honestly. What it is, why it exists, when it's a genuinely smart tool, and when it's the first domino in a financial mistake that takes a decade to unwind. Welcome back to Fred Talks Financials. I'm Fred, a practicing anesthesiologist, and every week here we take one piece of physician finance and actually look at it honestly, tool and trade-offs both, instead of just selling you on it or scaring you off it. Today's topic is one almost every resident and new attending gets pitched at some point: the physician mortgage. A physician mortgage, sometimes called a doctor loan, is a specialty loan product that a lot of banks and credit unions build specifically for physicians, dentists, and sometimes other high-income professionals still early in training. The core features that separate it from a conventional mortgage: a low or even zero down payment, no requirement for private mortgage insurance even below the 20% down threshold that would normally trigger it, and underwriting that can count a signed employment contract, including a future attending salary that hasn't started yet, as qualifying income, rather than looking only at a resident's or fellow's current pay stub. It's not a government program, and it's not universal. Availability, exact terms, and which lenders offer it vary and change over time. But the shape of the product is consistent enough across most versions that the trade-offs I'm about to walk through apply broadly, regardless of which specific bank is offering it to you. This isn't charity, and understanding why banks do this tells you a lot about how to use the product wisely. Physicians are, as a class of borrower, an unusually good bet. Extremely low historical default rates, income that reliably rises steeply and predictably after training, and, often overlooked, a relationship a bank hopes turns into decades of other business, checking accounts, other loans, wealth management down the line. The bank is underwriting your trajectory, not just your current paycheck, because physician trajectories are unusually predictable compared to almost any other profession. That's a real advantage for you as a borrower. It's also worth sitting with for a second. The bank's confidence in your future income is precisely what makes it easy to borrow against a future that hasn't happened yet. Said plainly, so this doesn't read as one-sided. The advantages are real. Skipping a large down payment means you're not draining cash reserves or delaying a home purchase for years while saving one, right at the exact life stage: end of residency, start a fellowship, or attending life, when your income is about to change dramatically anyway. Avoiding PMI, which on a conventional low down payment loan can add a meaningful monthly cost with no benefit to you as the borrower, is a genuine savings. And underwriting against a signed offer letter instead of a resident's salary solves a real chicken and egg problem. Without this product, a lot of physicians simply couldn't qualify for a home near their new job at all, based on the income they're earning the month before they started. For a physician who's confident in their location, has a stable dual income household or manageable debt load, and isn't already stretched thin elsewhere, this product does exactly what it's designed to do. Here's where it gets more complicated and where I want to spend real time, because these risks don't show up on closing day. They show up 2, 3, 5 years later. Student loan debt to income gets quietly deprioritized. A physician mortgage often qualifies you based on future income without weighing your existing six-figure student loan balance the way a conventional lender might. That doesn't make the loans disappear. It just means the mortgage decision and the student loan decision get made independently when they should be made together. A house payment sized for what I can technically afford without accounting for aggressive loan paydown is a house payment that quietly starves your debt payoff plan. Retirement savings gets delayed by default, not by decision. Zero or low down payment means more cash stays liquid up front, which sounds good until that cash goes toward furniture, a second car, and lifestyle setup instead of catching up on the 401k and Roth contributions you skipped during training. The mortgage itself doesn't cause this, but removing the forcing function of a large down payment removes a natural brake on spending at exactly the moment income is about to jump. Job location. Uncertainty is a real cost, not a hypothetical. A lot of physicians buy in their first attending market assuming they'll stay, and a meaningful number don't. A practice doesn't work out. A partnership falls through. Family circumstances change. Selling a home within 2 or 3 years, especially with little equity built up from a low down payment, can mean eating transaction costs and any market softness directly out of pocket. Sometimes writing a check at closing instead of walking away with proceeds. And lifestyle inflation is the quiet one. A physician mortgage often qualifies you for more house than a conventional loan would, precisely because it's underwriting your future. Qualifies for and should buy are different questions. And the gap between them is where a lot of the house poor attending stories actually start. It tends to make sense when you're reasonably confident in your job and location for at least the next several years. Your student loan strategy is already decided, whether that's aggressive payoff, PSLF, or refinance. And the mortgage decision isn't competing with it for the same dollars. And you're buying a home sized for your current life stage, not the attending salary you're about to start earning. It tends to become a trap when you're using it to qualify for a home you couldn't otherwise afford on a conventional loan and haven't asked why that gap exists. Your location or job situation genuinely isn't settled yet. Your student loans don't have a real plan, and the mortgage is quietly becoming the priority by default. Or retirement savings has no plan to resume once the mortgage is signed. It's just, we'll get to it later. The tool isn't the problem in either case. The readiness of the rest of your financial picture is what decides which of these two outcomes you get. Before signing, walk through 4 questions. In this order. First, is my student loan strategy already decided independent of this mortgage decision? Second, am I reasonably confident about this job and location for at least the next 3 to 5 years? Third, does this monthly payment still work if I fully fund retirement savings starting now, not later? And fourth, am I choosing this home size because it fits my life, or because the underwriting told me I qualify for it? If you can answer all 4 with a genuine yes, a physician mortgage may be a tool worth evaluating seriously with your advisor and lender. If 2 or more give you pause, that's not a reason to panic. It's a reason to slow down and get the rest of the picture settled before you use this particular tool. A physician mortgage is a tool, not a verdict. Used by someone whose broader financial life is ready for it, it's a genuinely smart way to buy a home at exactly the life stage most physicians need to. Used to stretch into a house sized for an income you don't have yet, while your student loans and retirement savings quietly wait for later. It's how a lot of otherwise disciplined physicians end up house poor without ever making a single obviously bad decision. Quick disclaimer: this video is general education, not personalized financial, tax, or legal advice. Whether a physician mortgage makes sense for you depends on your specific loans, income timeline, and life plans. That's worth a real conversation with a fee-only financial advisor and a mortgage professional who works with physicians specifically. If this helped you think it through, subscribe. I post videos like this every week for physicians building a real plan around a real career, not a textbook one. And if you're earlier in training, check out the Backdoor Roth IRA and Residency Money videos in this series. They're worth having settled before this decision, not after. See you next week.